Welcome back to the GMS Weekly Podcast, where we break down the developments shaping the global ship recycling markets. I'm Greta.
And I'm Henning. This week, the market seems to be adjusting to a reality that's becoming harder to ignore. The disruption around Hormuz may not be temporary anymore.
Exactly. Talks between Washington and Tehran remain deadlocked. Sanctions pressure is increasing, and traffic through the strait is still operating under uncertain conditions.
And perhaps the clearest sign of that uncertainty is what some vessels are reportedly doing while transiting the strait, switching off their transponders.
Which says quite a lot about the operating environment. Ships are still moving, but normal navigation certainly hasn't returned.
And more importantly, the market is beginning to behave as though this may be the new operating reality rather than a short-lived interruption.
That's an important distinction. Earlier in the conflict, owners could still assume that conditions might normalize quickly. Now, routing, insurance, compliance, and timing decisions are increasingly being made around prolonged disruption.
And the energy market is reflecting that tension as well. Oil climbed through most of the week before pulling back on Thursday. Brent finished around $87 a barrel, still roughly 5% higher on the week.
But the oil numbers themselves are quite contradictory.
They really are. The IEA sharply increased its estimate of the global supply deficit, while at the same time, U.S. crude inventories recorded their biggest weekly build since early 2023.
So globally, supply looks tight, but some of that oil is clearly ending up in the wrong places.
Exactly. And for shipping, that means volatility rather than a simple shortage story. Regional dislocation matters just as much as the headline supply number.
Freight gave us another example of that volatility this week.
Yes, after last week's surge, the Baltic Dry Index reversed again, falling to around 2,844.
And Capesizes took the biggest hit.
Down about 12% on the week, with the index falling back to around 4,469. Panamaxes also ended their winning streak, while Supermax levels touched a 9-week low before stabilizing.
From a recycling perspective, that matters because weaker freight should, in theory, make owners more willing to consider selling older vessels.
In theory.
There's the important qualification.
Exactly. Freight has been moving so sharply in both directions that owners still have reason to wait. Earnings soften, recycling becomes interesting, and then freight turns again. So candidates are being shaken loose psychologically, but not necessarily physically.
And that hesitation matters in a market where buyers are already competing for limited units.
Very much so. The recycling side may be willing to transact, but availability remains the central problem.
Which brings us to the recycling destinations, because this week the individual markets behaved very differently.
Bangladesh probably had the most interesting change in character.
Definitely. Chattagram's August tide window has been active. Operations are functioning normally again. And the bigger development is buyer appetite.
Especially for tankers.
Yes. After spending much of July cautious around tanker histories, Bangladeshi recyclers have suddenly become very aggressive for small and mid-sized tanker tonnage.
Specialist tanker and container indications moved about 4.5% higher week on week.
And that's particularly interesting because local steel didn't really support the move.
Exactly. Plate briefly strengthened during the week, but settled back near 64,000 taka per ton. So this is not a steel-driven rally, it is buyer competition.
Which tells you something about where recyclers see value. They're prepared to stretch on the right tonnage even without a major improvement in the underlying steel market.
And Bangladesh still sits at the top of the pricing table. Dry bulk indications are around $445 to $450 per LDT, tankers around $470 to $475, and containers around $480 to $485.
The macro backdrop helped as well. Bangladesh inflation eased to 8.32%, down from 9.16%. Which is the softest reading of the year.
That doesn't transform the market overnight, but it does remove some pressure from the broader operating environment.
India, meanwhile, almost gave us the opposite story. Stronger steel, but weaker sentiment.
That's right. A long plate recovered to around 39,500 rupees per ton by Friday, but buying interest became more selective again.
And India's inflation picture was less friendly, too.
July CPI climbed to 4.45%, a 19-month high, driven largely by food prices. That has brought the possibility of future rate hikes back into the conversation.
But even with softer recycling sentiment, Along has one very important vessel sitting in front of it.
FT Island.
A 43,402 LDT oil tanker. the largest recycling candidate the basin has seen in months, now at anchor awaiting its tide.
That vessel alone makes India worth watching closely. A unit of that size can influence sentiment well beyond one transaction, particularly in a market that has been starved of large candidates.
And we also got a useful confirmed price this week. Pine Arrow's delivery at Alang was verified at $445 per LDT.
Which gives the market something it has been short of recently, an actual transaction level rather than just indications.
In a thin market, that matters.
It does. A confirmed print helps buyers, owners, and cash buyers reset expectations around what is actually executable, rather than where theoretical numbers are being discussed.
Pakistan, on the other hand, was probably the most stable market of the week.
Almost unusually stable.
Plate held around 200,000 rupees per ton. Local demand remains firm. Recyclers are willing buyers. But there simply aren't enough available vessels.
That's the key point. Adani's problem is not appetite, it's supply.
And the recently secured candidates are still in transit.
So for owners, Pakistan continues to offer a fairly straightforward proposition. No tide constraint, hungry yards, a very stable currency, and relatively uncomplicated execution.
Which can be valuable when other destinations are moving more aggressively, from week to week.
Absolutely. Sometimes certainty itself becomes a pricing advantage, especially when an owner is comparing a slightly higher headline number with a smoother delivery process.
Turkey?
Very little change in the recycling market itself. Aliaga indications remain between roughly $262 and $284 per LDT, depending on vessel type.
And the lira continues its familiar slide.
Another fresh record near 47.83 to the dollar. Turkey's competitive position remains based on regulation, compliance, and specialist tonnage rather than headline pricing.
So there's very little change in its role within the wider market.
Exactly. Turkey remains a specialist destination rather than a direct price competitor to the subcontinent.
So Henning, if you step back from all the individual markets, what's the main takeaway this week?
I think the biggest change is psychological. The industry is starting to behave as if geopolitical disruption is no longer something you wait out.
I agree. The market is beginning to price around it instead.
And within recycling, the competition is becoming more selective. Bangladesh is pushing hard for tankers. India has cooled but still has major tonnage in front of it. Pakistan remains ready to buy but needs candidates.
And freight has weakened, but not yet enough, or consistently enough to create a clear wave of recycling supply.
Exactly. So owners are still balancing two very different options. Keep trading into an unpredictable freight market, or lock in recycling value while subcontinent buyers are still competing for limited tonnage.
And for cash buyers, that means the challenge isn't simply finding the highest destination anymore. It's matching vessel type, timing, compliance profile, and delivery certainty to the right market.
That's where this week becomes especially interesting. The board may show Bangladesh first, Pakistan second, and India third, but the best destination for an individual vessel can still look very different depending on the unit.
Which makes the four themes this week fairly clear.
Talks stall,
Tanks fill,
freight reverses,
and inflation prints diverge.
but perhaps the most important line is this: the market is no longer waiting for peace before making decisions.
It's learning to operate around uncertainty.
And that may prove more important for recycling supply than any single weekly move in freight or steel.
That's all for this week's GMS Weekly Podcast.
Thanks for listening. We'll be back next week with the latest developments from across the global ship recycling markets.
Until then, stay safe and stay informed.